Hey folks, my name is Mansoor Sohail. You may call me Manny for short. I'm an accountant operating out of Scarborough, Ontario, and I specialize in taxes for Canada and USA. My today's presentation is for educational purposes only, and I will be talking about cash flow statements today. Cash flow is a measure of how much cash a company has available or spent over a certain time period. An income statement does not provide us a measure of cash generated. A corporation may have generated sales of $1 million in a year. If only 20% of its sales were paid in cash, it means total cash generated during the year was only $200,000. A cash flow statement will determine how much cash is generated in a year. It's broken into three parts: cash from operating activities, cash from investing activities, cash from financing activities. A net result from operating activities, investing activities, and financing activities will give total amount of cash spent or received in a given period. Cash from operating activities. Let's talk about that. Cash from operating activities represents generation of cash from net income. In preparing cash flow statement, we have to adjust income based on revenues received in cash. We also have to make adjustments to expenses paid in cash. Both these adjustments affect income statement. So let's take a look at an example. Let's say our revenue is $10 million and we collected all of it in cash. We also received an invoice for $2 million and we did not pay this invoice. Our net income in this case is 8 million. How does it affect cash flow? Our net income is 8 million. We add back the invoice that we didn't pay, that is 2 million. So cash from operations becomes 10 million. Let us assume that out of our sales of 10 million, we only collected 8 million in cash instead of 10 million. Following is the analysis of this assumption. Income statement, we have revenue of 10 million. Invoice we did not pay is 2 million. Net income is 8 million. Let's look at cash flow. Net income is 8 million. Revenue we did not collect is 2 million. We add back invoice that we didn't pay, 2 million. So cash from operations becomes $8 million. So cash from operation equals cash from operations equals net income plus expenses we did not pay minus the revenue we did not receive. Income statement has other components to it that also need to be looked at to get a better understanding of cash flow. This will help us determine which items can be considered cash or non-cash. Revenue. If sales are on credit, you need to remove accounts receivable from net income. Cost of goods sold. Cost of goods sold is the cost of inventory. We expense COGS and reduce inventory when recording cost of goods sold. A reduction in inventory will result in positive cash flow. Operating expenses. Accrued expenses are added back to net income. Depreciation. Depreciation expense is always added back to net income when calculating cash flow from operations. Interest expense. Interest expense is almost always considered as cash expense, so it is not added back on the cash flow statement. Taxes. If we expense taxes but did not pay yet, these are called deferred taxes. So how does this affect? Let's look at the income statement line items and let's see the effect of all these items. First column is net income line items. Second column is possible deferred items. And third column is effect in cash from operations. Revenue. It is a possible deferrable item. Yes. And change in account receivable occurs. That's the effect. Cost of goods sold. Yes. And change in inventory and accounts payable occurs. Operating expenses. Yes. Change in accrued expenses and prepaid expenses. Depreciation. Yes. It will affect depreciation. Interest. No. Uh, some exceptions, but usually there is no effect. Taxes. Yes. And it affects deferred taxes. We can generalize above table towards cash flow from operating activities as under. Cash flow from operating activities equals net income plus changes in accounts receivable, changes in inventory, changes in accounts payable, changes in accrued expenses, changes in prepaid expenses, plus depreciation, plus deferred taxes. A definition for changes in working capital equals changes in accounts receivable plus changes in inventory plus changes in accounts payable plus changes in accrued expenses plus changes in prepaid expenses. And we can merge this change in working capital definition in our equation as below. Cash from operating activities becomes net income plus depreciation plus deferred taxes plus other non-cash items plus changes in working capital. Cash from investing activities. Let's talk about it. Cash from investing activities comes from capital expenditure like investing in property, plant, or equipment, buying or selling assets, buying, selling, spinning off, or splitting off businesses, buying or selling of marketable and non-marketable securities. Cash from financing activities. Cash from financing activities comes from raising or buy back equity or preferred securities, distribution to equity holders. Let us see this flow in financial statement in the following example. Let's say we have raw materials and the cost is 50 per item. Let's say the selling price for an item is 100. We purchase raw material for building 10 items, which equals 500. Our cash flow would look like net income is 0 because we haven't sold anything yet. Changes in inventory is 500. Total changes in cash is 500. So our balance sheet would look like a negative balance in cash and a positive balance in inventory. Let us say that vendor allows us to pay him later for inventory we bought. We end up in incurring a liability of accounts payable in this case. So what happens to the cash flow? Changes in inventory is 500 negative for the cash flow purposes. Changes in accounts payable is 500. Total changes in cash is 0. Effect on balance sheet. Cash equals 0. Inventory we have 500 in positive. Accounts payable we have 500 in positive. Let us say we sell one item for 100. It will have following effect on the income statement. We will record a revenue of 100. We will record COGS for 50. Let us also assume that the tax rate is 40%. Our income statement will look as below. Revenue is 100. Tax at 40% is 40, and net income equals 60 after paying the taxes. Our cash flow and balance sheet will look like as below. Net income will be 60, so total change in cash is 60. On the balance sheet side, we have cash equals 60, sorry. Cash equals 60. Inventory is 500. Accounts payable is 500. And our retained earnings equal 60. What will happen to COGS? On the income statement, COGS is negative 50. Taxes at 40% is 20. So net income equals 30 negative because of the COGS. COGS is a part of inventory that we need to reduce because one item is sold. This will result in positive cash flow and will affect cash flow and balance sheet as below. Cash flow side. Net income equals negative 30. Changes in inventory is 50. Total change in cash is 20. Balance sheet adjustments would be cash equals 20. Inventory is negative 50 because 50 cost $50 inventory is gone out. Retained earnings will be negative 30. Our balance sheet will change after adjustments as below. So when we bring these adjustments in the balance sheet, our final balance sheet will look like cash equals 80. Inventory is now 450. Accounts payable is 500. And retained earnings, net income equals 30. Let us now assume that we sell one more item at 100, but this sale is on credit. Our income statement will look as below after this sale. Revenue is 100, taxes at 40, net income after paying the taxes equals 60. Cash flow statement and balance sheet will look like as below after the above transaction. Net income is equal to 60. Change in accounts receivable is negative 100. Total change in cash is negative 40. Balance sheet adjustments look like cash equals negative 40. Accounts receivable is 100. Retained earnings equals 60. So our adjusted balance sheet looks like cash equals 40. Inventory equals 450. Accounts receivable is 100. Accounts payable is 500. And retained income will be 90. Let's move on and adjust our COGS and inventory. What happens on the income statement? COGS is negative 50. Taxes at 40% equals 20. So net income becomes negative 30. Cash flow looks like net income is minus 30. Changes in inventory is 50. And total change in cash equals 20. Balance sheet adjustments are cash equals 20. Inventory is minus 50. Retained earnings net income is negative 30. Balance sheet after adjustments looks like cash equals 60. Inventory is now down to 400. Accounts receivable is 100. Accounts payable is 500. We have not paid any accounts payable yet, so it stays at 500. And retained earnings equals 60. Let us now assume that the remaining 8 items are sold, out of which We have sold 4 items on credit. Income statement will look as under. Revenue is 800. Taxes at 40% equals 320 negative. So our net income will be $480. We need to remove 400 of the net income on the cash flow statement. So net income on the cash flow is 480. Changes in accounts receivable negative 400. Total change in cash equals 80. Balance sheet adjustments, cash equals 80. Accounts receivable is 400. Retained earnings 480. Let's look at the adjusted balance sheet now. So cash will be 140. Inventory 400. Accounts receivable 500. Accounts payable 500. Retained earnings increased to $540. Let's adjust our cost of goods sold and remove the inventory. So income statement, what's happening on income statement? We have COGS of negative 400. Taxes at 40% equals 160. And net income equals minus 240. Our cash flow looks like net income is minus 240. Change in inventory is 400. Total change in cash is 160. Balance sheet adjustment, cash equals 160. Inventory negative 400. Retained earnings negative 240. And our adjusted balance sheet after the adjustments looks like cash equals 300. Inventory is now 0. Accounts receivable is 500. Accounts payable is 500. Retained earnings or income is 300. Let us say we collect 500 on accounts receivable. Our cash flow looks like this. Net income equals 0. Accounts receivable is 500. Total change in cash is 500. Balance sheet adjustment looks like this. Cash equals 500. Accounts receivable is negative 500. Retained earnings equals 0. So our final balance sheet after the adjustment looks like cash equals 800. Inventory 0. Accounts receivable 0. But we still have accounts payable 500 and our retained earnings equal 300. Let us pay our liabilities from the cash available. So cash flow looks like net income is 0. Accounts payable is negative 500. Total change in cash is negative 500. On the balance sheet adjustment side, cash equals negative 500. Accounts payable is negative 500. Retained earnings equals 0. Our final balance sheet after all the adjustments look like this. Cash equals 300 after all the transactions. Inventory is now 0. Accounts receivable is 0. Accounts payable is 0. And our retained earnings equals 300. I hope you enjoyed this presentation. Source of this information comes from Financial Modeling and Valuation, a wonderful book written by Paul Pignataro. Thank you.